Hey everyone, thanks for hopping on real quick for a webinar today. Today's topic, we'll actually be going over personal finance. And this is something I'm very passionate about. And today's topic in specific is going to be building a solid financial foundation. And before we start going over the presentation itself, I do want to do some housekeeping. First up, want to quickly introduce myself. My name is Brandon Chan. I'm actually a wealth manager over here in Pasadena with Cetera Investors. I've been in the industry for about 7 years now, helping clients and mainly millennials and young professionals with their finances to get them set up for their future right there. Also, I do want to give everyone a heads up. My team here does have a website, toriandalex.ceterainvestors.com. Highly encourage everyone to hop on to the website to get more information in regards to, our blog posts, watching our informational videos, our contact information to, reach out to us whenever you want, as well as, buttons to help schedule meetings if you guys have any questions along the way. Like I said, my team does have videos that we like to post on YouTube and our website. So for our complete catalog, check out Tori and Alex over on YouTube. And in regards to my videos, under our team channel at Tori and Alex on YouTube, we have a specific playlist in regards to building better financial habits with Brandon. This is my series where I go over different topics in regards to personal finance. So, without further ado, I'd like to take some time to go over what we're going to be discussing today in regards to building a solid financial foundation. So, I do want to take a quick second to kind of go over a Twitter quote that I found very interesting when I first started in the industry. And it essentially says, if you can't manage $1,000, you can't manage $10,000. You don't suddenly learn how to handle money by amassing more of it. This is why a lot of lottery winners lose it all. Financial literacy is not a side effect of wealth. Wealth is a side effect of financial literacy. And this is going to be in a very important kind of theme in regards to personal finance and how to accumulate wealth for you and your journey. So to start off, there's actually going to be three topics we're going over today. Before I do so, we'll be going over what the goals are for today as well with today's seminar, or should I say webinar. Afterwards, we'll go over budgeting 101, credit as a consumer, debt, paying off debt, and then lastly, kind of the next steps after that. So to start off, in regards to our goals for today, I want you guys to understand the importance of a budget. We're going to go diving into the mechanics of credit. Next up, we're going to be actually exploring some ways on how to pay off debt. And then lastly, that'll help you build a solid financial foundation for success right there. Awesome. So first off, we're actually going to be going over budgeting 101. So in regards to budgeting, I found two things that are beneficial when it comes to budgeting. First one, it's going to help you maximize assets. And the second one, it's actually going to help minimize debt. I've been able to boil this down into a essentially 5-step guide, and I'll have it down here below as well. But first off, we're actually be calculating your monthly income that comes in through the door. Second, we're going to be calculating your monthly expenses. Third, we're going to actually be developing a savings plan that's meant for you. Fourth, we're going to utilize what you put down on your spending plan and help you minimize your expenses from what you're currently spending today. And then step 5, essentially rinse and repeat steps through 2 through 5 in a timely fashion. So to start off in step 1, we're going to essentially calculate your monthly income. And this is going to help figure out what our after-tax income is for what we can utilize throughout our whole budget. So if you're being paid bi-weekly, so every 2 weeks, I want you to take your take-home pay, essentially what you're getting after taxes and all your deductions right there, take that amount and multiply it by 26 because there are 26 pay periods per the year, and then divide that by 12 to get your average monthly income. Now, if you're paid weekly, it's a little more simpler. Just multiply your after-tax income by 52 and then divide that number by 12 to get your monthly income right there. So very simple. Now, step 2, we're actually going to be start to calculating our expenses. So I first want you to list off all your expenses that you pay for on a monthly basis from top to bottom, and then we're going to categorize them into two columns. First one is going to be your fixed expenses that include your mortgage, your rent, your car payments, car insurance, health insurance, utility bills, internet, TV, self-med, anything of that sort that you know is going to be the same dollar amount every single month. Now, in the second column, we're actually be listing down all of our variable expenses. So this is anything that's going to be, different every single month. That may include travel, dining, gifts, and entertainment. And then after you categorize essentially what is fixed and what is variable, we're going to evaluate and adjust accordingly. But I want you to take a step back at this point and see if the money that you're spending in regards to your expenses, does anything kind of pop out to you right there? And then we're going to go actually touch upon that later on. But I just want to put that question out there first. Now, step three, we're actually going to develop a spending plan right here to utilize for your actual income. Now, this is a general rule that I like to give everyone. This is going to be the 50-30-20 rule, where 50% of your income goes towards your needs. That's going to be rent, food, and debt repayments right there. 30% of your income goes towards your wants, taking a trip, in the future during summertime, entertainment, going to the movies, gifts, Christmas is coming up, anything like that. And then lastly, 20% of your income goes towards your savings. And this is anything like your emergency fund, anything towards your future home purchase, or a car purchase right there, or retirement. Think of, 401ks, IRAs, anything like that right there. Now, one thing I do want to note is that this rule is not set in stone at the end of the day. But I hope this is a good template for you guys to start with. Some people maybe like to do the 70-15-15 rule. That still equals to 100% of your income, of essentially of your dollars, going to work for you right there. So I want you to find something that works for you and that you're comfortable implementing into your own spending plan right there. Okay, awesome. Step four, we're actually going to start to minimize our expenses. And this is where you kind of take a step back also and see from your fixed and variable expenses, where can I cut things out if I need to at the end of the day? So I want you to compare essentially your standard of living with your expectations and with reality right there. Would you rather live large now with debt or live, smaller and break even or to save even cash right there? And essentially, one tip, of course, eliminating or reducing eating out, compare essentially your wants and needs in life. Some helpful tips right here shown on the screen, essentially to shop with lists. If you know you're going to go to a grocery store, don't go hungry, and also shop with a list to make sure you're getting everything that you need that fits in within inside your budget. I don't want you to go spending out like, oh, maybe I'm gonna get a can of soda water or some extra, meals to have in the freezer, anything like that, right there. Another thing is to not confuse luxuries with necessities. A good example would be maybe a car. Instead of getting that luxury car that you need to use to get to work, how about you get a more modest car that can help save you money on the monthly basis with your not only your car loan itself, but also your monthly automobile insurance that can help save you dollars right there. And last tip, maybe I'd recommend is if you have a big purchase coming up, take a night to sleep on it. You don't have to make the decision right then and there, but if you take the time to maybe sleep on it, think about it, hopefully you can make sure that decision is the right one for you at the end of the day. And also, us as planners, we're not here to tell you how to spend your money at the end of the day, but we hope that your spending aligns with the values that you carry on without your life. And then lastly, step five is to repeat steps 2 through 5. And it's good practice to essentially repeat these steps, maybe on a monthly or quarterly basis, depending how granular you want to get within your budget. Next, I would also recommend to review your expenses, and discretionary spending to make sure they still align with your budget. And, lastly, I want you to do like a self audit of your outstanding debt, whether that be credit cards, student loans, personal loans, anything of that sort, and plan to pay it off if you haven't already done so. And this is, where we kind of go back to the benefits of budgeting, where our goals are to maximize assets and minimize debt at the end of the day. So that's budgeting 101, kind of in a quick five-step process for everyone to understand. Next thing we're going to be going on is actually in regards to credit as a consumer. Now, what is credit? Well, credit is the ability to borrow money under the agreement that you'll repay the debt later. Now, this essentially is from, leasing a car to buying a home with a mortgage. Credit itself plays a huge factor. And today we'll actually be going over, two main types of credit that most people are accustomed with. First one is going to be revolving credit. So this is essentially your credit cards right here. And then the other type of credit is actually going to be installment credit. So anything that's essentially paid on a monthly basis or a regular basis with a fixed dollar amount. This can be student loans, auto loans, and mortgages right there. So I want to take a step back and get to the question of like, how do I get credit or how do you get credit under your belt? And because everyone has to start somewhere. So I listed here a couple of ways on how to get started with your credit journey. First one, for those who are maybe haven't started and don't have a credit card, maybe applying for a secured credit card can actually help get your foot in the door to build your own credit. Second one out is actually going to be taking out a secured loan right there. Third one, if you're maybe on the younger side, maybe becoming an authorized user on someone else's card, like a parent, a responsible family member, or even a close friend. And another way is to actually get credit by paying bills on time. Experian does have a new program that allows people to pay bills on a regular basis and actually can actually help build credit. And I will say it's a fairly new kind of ability that Experian has for their members, but it's going to be building out more and more in the future. And lastly, is actually be consider a co-signer or co-applicant either on a credit card or on a loan that can help build credit or can essentially start to build the credit. Now, I get this question a lot right here, but what is a credit report? Now, a credit report is a financial record containing information about an individual's history of borrowing and repaying debt. And I highly recommend everyone to visit annualcreditreport.com for your free credit report every single year. This report itself is essentially created by creditors for other creditors to kind of see who you are as a person. And this credit report, is used to actually calculate your credit score. Now, before I go into what the credit score is, I definitely want to make sure you guys know about what's on your credit report and how to make sure you're getting the most out of it. And essentially, information on there is essentially maybe it's employment histories and address histories, number and types of inquiries when you do open those new personal loans, any loans out there, or any credit cards. It's essentially a type of inquiry looking into your credit report, and other creditors or credit bureaus can look into it to see, what's been happening or what you have been doing with your credit right there. And another portion of the credit report is actually in regards to payment history on all your debts. They actually look at maybe back upwards to 7 to 10 years of your payment history to make sure, hey, are you paying all your bills on time? And some other things as well are going to be amounts, age, and types of debts, some public records as well. If you've ever been evicted, some bankruptcies or any court judgments, those stay on there as well. And any negative information from the last 7 to 10 years right there. Now, why should you get your free credit report? And there's two reasons why that I found. First one is to protect your credit history from errors. You may have made that, credit card payment on time, but maybe it was deemed as, late by your credit card company. company. So if you saw that error on your credit report, but you knew you actually paid that bill on time, you can go back to the credit bureaus that have your credit report and show that, hey, this is actually wrong. Because at that point, if you leave it on there, it could damage your credit score at the end of the day. Now, the second reason why I, recommend people getting their credit report is to help spot signs of error or I'm sorry, identity theft. You know, identity theft, many people are affected by it every single year. You may not see it on the day-to-day basis, but when you may look at your credit report, you may see someone may have taken out a credit card in your name that you don't recognize or maybe a loan, whether that be a new car, a mortgage, anything like that. If you see any signs of identity theft, this is going to be one of the places to actually see it. Now, the big question, what is a credit score? Now, this is a numerical value of your credit risk. Essentially, they're looking at, hey, are you able to pay back what you owe? Now, the credit score is a range of numbers, and the higher the number, the less risky you are. Now, when it comes to the range, it actually starts on the low end of 300 and going upwards to the high end of 850. Now, the two most popular credit scores out there that many people hear about are going to be the FICO score as well as the Vantage score. Now, going deeper into the credit scores themselves, there are actually five big factors that play a huge role in calculating your credit score. Now, first one is going to be the payment history. The credit score, 30%, or I'm sorry, 35% of your credit score comes in the form of payment history. So are you making your payments on time? Right there. The second portion, the second largest portion, is actually going to be your amounts owed. So they're going to be looking at, oh, how much are you spending or how much do you have owed compared to your available credit or how much have you paid off as well. And then the smaller ones, roughly around 10 to 15% each, going to be new credit, credit mix, which essentially is, types of credits, whether it be credit cards, installments, loans, or, revolving credit, anything like that. And lastly, you know, length of credit history. So they see how long have you kept up with the loans? How long are the loans? As well as how long have you had those credit cards for? Those types of situations. And that's essentially what the credit scores are. Now, next I'm going to go over are some myths that I've heard my clients talk about and that I do want to shed some light on to show everyone that some of them are false right there. So the first myth that is false is checking my credit score or checking my score lowers my credit score right there. People think that whenever they log on to their credit reports to see their scores, everything like that, every time they do that, they think their credit score is going to tick down, tick down, tick down. Actually, by doing this, this is only a soft pull and not a hard pull or hard inquiry. So by looking into your own credit score, there's actually no effect in regards to what your credit score is going to do. Now, the second one that I have heard a lot of people think that is true, but it's actually very false. I want everyone to stray away from this, but is carrying a balance on my credit card boosts my credit score. And this is one of the ones I hear the most on. And I definitely would tell everyone that please do not leave a balance on your credit cards to boost your score, because that's actually false. By leaving a balance on your credit score or credit cards, I would say, can actually have a negative effect in regards to your credit score. First off, by leaving a balance, you're paying interest on that credit card right there. That is essentially you spending more money to keep the balance on there. Essentially paying money to leave money there that you essentially owe to the creditors. Now, in regards to the score, in the previous slide, we looked at 30% of your score equating to amounts owed right there. And leaving a balance on your credit card essentially eats up into your credit limit. And they have this what they call utilization ratio that essentially dictates if you use too much of your credit limit, essentially the banks or the creditors that are essentially or lenders that are essentially giving you that credit card are going to be looking into you and saying, hey, you are using more than what we expected in regards to the limit we've given you. You are kind of risky. Are you able to pay that back? And at that point, they actually may lower your score right there. And some other myths that I will say are false are actually using a debit card helps build good credit. And that's definitely false because your debit card is actually not linked to your credit report at all, right there, not even one bit. So it actually does not affect your credit score at all. And then next up, I don't need to worry about my credit score until I'm older. And then I fear that, have you go a long way without looking or checking your credit score or even doing any repairs to it when that time comes, when you want to buy that car, when you want to buy that house, or anything as such, it's harder for you to get the best interest rate out there, essentially costing you maybe hundreds or thousands of dollars at the end of the day. So if you take a proactive approach of making sure your credit score is in a healthy shape, you can save yourself money, time, and headaches right there. And the second, some other smaller ones I've heard as well are student loans don't affect my credit score. As we know, student loans are installment credit, essentially right there. So that still affects your credit score. And make sure you guys make your payments at the end of the day. And lastly, closing a credit card improves my credit score. Now, this is a yes and a no right here. Closing a credit card can improve your credit score if you don't, if it's a small balance or a small credit limit on there, and you maybe had the card for maybe a couple of years. But if it's one of your oldest, cards in your own pocket that you had for years, this is where a bulk of your credit history essentially is. And if you essentially close that account, you don't have any history under your belt. And at that point, it may affect your credit score and lower it right there. So that's essentially everything in regards to credit as a consumer. And next up, we're actually going to be going over how to pay off debt. I have some good information for everyone here. But before I do so, I kind of want to show everyone, what the effects of debt are. Now, first off, how many Americans are in debt? And I've done some research from debt.org, and I found some very interesting information. So first off, the American household debt hit a record of $16.9 trillion dollars at the end of 2022, according to the Federal Reserve. Now, looking at that number on the screen, that's a lot of zeros right there. And what I found also is that 77% of American households have at least some type of debt, whether that be credit card debt, loans, student loans, car loans, mortgages. Now, I do want to say this is that not all, debt is created equal. There are some debts that are good and some debts that are bad. I will say majority of them are bad if you leave a balance on there. Now, in quarter four of 2023, credit card debt surpassed $1.13 trillion dollars. Now, if we take that number and average that out amongst all the Americans in the United States, that essentially means that every single person roughly had a little over $6,000 in credit card debt. And that's a scary number right there. That's already hitting four figures right there of debt. If we just spread that 1.13 trillion amongst all the Americans in the United States, over $6,000. That's very scary. And some of the reasons that, equate to essentially all the debt here, inflation is one of them, slow wage growth and lifestyle creep. Those are the ones that I've seen also within my clients. Now, next up, how do we get rid of this debt? And I found three ways to help people pay off debt. First one is going to be debt consolidation. Second one is going to be debt avalanche. And the third one is going to be debt snowball right here. So we'll go over the first one, debt consolidation. What is this? It involves taking out a new loan or other debt and using it to pay off several existing debts. You know, this typically, is utilizing the new debt, hopefully having a lower interest rate than the current debts, which helps people pay off all the debt and lower their interest rates, saving them money at the end of the day. And then with all the debts that people currently have, essentially combining that into one may help them and may help people consolidate everything and make their behavioral choices much easier compared to trying to juggle, 5, 10, credit cards, everything like that, making sure all your payments are in order. When we can just solidify it and just or essentially consolidate it into one payment, it makes it much easier for people to kind of focus on paying off debt. And there are two primary ways that people consolidate debt. First one is going to be zero interest balance transfer credit cards. And the second one is going to be, fixed rate debt consolidation loan. More than likely, a personal loan right there. Now, I do love pros and cons charts right here to show what what essentially the methods work out to be. And we'll focus on the left side first. On the pro side of debt consolidation, by utilizing this, it can potentially lower the interest rates, saving you money at the end of the day. It can definitely help pay down debt faster, depending on how fast you want to pay it off, 1, 2, 3 years, maybe a couple months, anything like that, and definitely helps you organize the debts rather than trying to juggle like 5, 10 credit cards or personal loans. You only have one payment to pay off at the end of the day. Now, definitely there are some cons to this. Generally, you do need a good credit score to get a lower interest rate. And if you don't have a good credit score, it's definitely harder to qualify for these personal loans or for these credit cards to get the good rates right there. Next up, it's going to be another credit check or what they call a hard pull or hard inquiry on your credit score. And when a lender looks into your credit score utilizing a hard inquiry or a credit check, this will lower your credit score just by a couple points for the time being right there. And lastly, there may be some upfront costs fees as well that you have to pay to get access to the debt consolidation method right there. Why spend more money when you're trying to pay off the debt that you already have right there? And that's going to be debt consolidation. Now, the second method we're going to be going over today is going to be the avalanche method. And I've actually broken this down into 5 steps. So essentially, what it is, you're going to be listing down all your debts with the highest interest rate all the way down to the smallest interest rate. And we're not going to be looking at the amounts owed on the debts themselves, just the interest rates. And then from there, we're going to make the minimum payments on all the debts, except for the one that has the highest interest rate. From there, you're going to throw any extra cash that you have on essentially in your pockets, on the sidelines, anything like that, to the highest debt until that is gone on a monthly basis. And hopefully, what this does is that once you keep paying off each individual debt that has the highest interest rate on there, and you just go from top to bottom, essentially you rinse and repeat. By the end of the all the debts, you should be done, and the last payment will have you debt free right there. Now, the pros of the debt avalanche method is essentially it helps you reduce the amount of total interest you pay. Then it also reduces the amount of time it takes to get out of debt because you're essentially focusing on the ones that have the highest interest rates that essentially charge you the most interest on all your debts. Getting that out first and then just slowly working your way down will help you essentially save money on interest. And then lastly, it's definitely great for budget-oriented people. Now, of course, there are always cons to everything. And the first one is gonna it really needs discipline as well as commitment to get everything done. And then lastly, it needs discretionary income. So you have to have extra money coming in to make sure you can put that towards all of the debts right there. The last method we're going over today is actually going to be in regards to the debt snowball method. What is it? Again, I made it into a 5-step process right here. First off, we're going to be listing all the debts from the smallest balance to the largest balance. We're not looking at the interest rate this time. we're going to be looking at just the dollar amount that you owe on all the debts. Smallest on top, largest on the bottom. And then from there, I want you to make all the minimum payments for all the debts except for the one that has the smallest balance. That's going to be the one on top. From there, I want you to throw as much extra money as you can to the smallest debt until it's gone, and then take what you were spending on your smallest debt that you're paying, and then add that payment to the next smallest debt until that one's gone. Essentially, rinse and repeat from top to bottom, from smallest to largest, until you're debt free. Now, the pros of this one is that it can definitely build a motivation by settling debts faster. Smallest one, maybe a couple $100, maybe a couple thousand, boom, that one's done. Going and going down the list right there. It'll help you keep motivated to make sure you finish everything. Now, definitely there are some cons in regards to this one, and this one does not reduce the interest as much as the debt avalanche method. In this case, you are maybe going to pay a little more interest than the debt avalanche method. And definitely, last con is that it can definitely take longer to become debt free. Now, if we take a step back, the question is, what is the best way to pay off debt? And I have to say this, it really depends because everyone is different. So first off, if you want to possibly lower your interest rate and pay off just one account and increase focus without having to juggle 5, 10 different accounts, that consolidation method is going to be the best right there. Now, if you want to save money, the most money on interest payments, and paying off debt the fastest, maybe the debt avalanche method is going to work the best. And lastly, if you find yourself if you find yourself paying smaller balances off and that actually helps you and kind of motivates you, then the debt snowball method is going to be the best. And like I said, everyone is different. Find what works best for you. Now, after we've gone over all three of the topics in today's discussion or webinar in regards to building a solid financial foundation, let's put all the pieces together. So, hopefully, you learned that having an appropriate budget enables you to purposely allocate and manage your expenses. Second, with an understanding of how credit works, you can leverage it into your advantage and manage a healthy score. And then lastly, with effective debt management, it is crucial for it to prevent you from consuming you at the end of the day. Now, I want to thank everyone for taking some time, to hop on this webinar with me to learn about building a solid financial foundation. And to help you get organized, we do have a program called Asset Map that is free for everyone to use. I highly encourage you to take a picture of the QR code right here to get you set up. And essentially, this is an exercise for you to kind of see what you have all in one page: assets, income, liabilities, everything like that, to kind of show you everything all on one page instead of having it in regards to like a Excel sheet. Hopefully, this can help you visualize from a bird's eye level what you have and where do you need to kind of focus your efforts on right there. And the next steps, I definitely would want you guys to fill out a budget worksheet. Next, I want you guys to get your free credit report from annualcreditreport.com. Begin your asset map from the previous screen. And if you have any questions or want to go talk more about how to pay off debt, credit, mechanics of it, as well as budgeting, set some time with me in the next couple weeks. And I want to thank everyone again for taking their time to hop on a webinar call with me to learn about personal finance and how to build a better foundation for financial success. Thank you.